Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, December 8th, 2022, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we are showing futures up, Dow futures up 82, S&P 500 futures are up about 13, NASDAQ futures up 37. Of course, we still do have a little more than an hour and a half to go before the opening bell. So we'll see how that translates into the open, but at least for now, it looks like maybe we'll have a fractional gap to the upside. Crude oil prices are rebounding a bit. Excuse me. We closed yesterday at about $72 a barrel. Up today, $1.75 to $73.75, which is a 2.4% increase. We've got the 10-year Treasury yield up 5 basis points to 3.46%. But yesterday we closed at 3.41%, and that was the lowest close on the 10-year Treasury yield in the past few months. So that takes us back into the summertime since we've seen yields this low. Let's go ahead and walk through today's agenda. So we're going to go into, we'll start off with the daily market recap, as we always do, and then talking technically. EB top stocks, going to take a look at a few of the big winners yesterday on some of our key chart lists that we use. Put call ratio, earnings spotlight, and the 3 you must see. Let me walk those of you that are new over to earningsbeats.com. If you go over to earningsbeats.com and scroll down, we have a free newsletter, Earnings Beats Digest, published 3 times a week, Mondays, Wednesdays, Fridays. We try to publish it by 8:30 in the morning, usually about an hour before the market opens, featuring the things that are really important to us. So we're looking at earnings, we're looking at gaps, we're looking at candlesticks, relative strength, moving averages, trend lines, a lot of the things that most technicians look at as well. There might be sentiment articles in there from time to time. I try to make it as educational as possible. If you'd like to join the EB Digest, it is free. No credit card required. You can unsubscribe at any time. And it only takes the name and an email address. Hit that subscribe button, and we will have you set up. In addition, a big benefit is anytime we have free webinars, we reach out to our entire Earnings Beats Digest community and invite them in for our free events. So it is definitely worthwhile signing up. We will be putting more and more information on our website here in the next few days, but we are now within 1 month of Market Vision 2023. That will be a free event. It will include a number of folks from StockCharts joining me, and we will be giving our take on the market, where we think it's going. We've done this now for the last 3 years. This will be our 4th year. Again, more and more information will be showing up on our website as we work our way through the rest of this week and throughout the month. But the event will be held on Saturday, January 7th. Mark your calendar, January 7th. It's a Saturday, 10 a.m. Eastern. That's when we'll get this thing started. I think it'll be an absolutely tremendous educational event and also a very valuable event. But anyway, stay tuned for more information there. But in the meantime, make sure you sign up for the EB Digest. All right. So daily market recap. What happened on Wednesday? Honestly, not a whole lot. We did get a little bifurcation yesterday in that the Dow Jones was actually up 1.5 points, but the other major indices were down, but they were down fractionally. So the S&P 500 down 7, NASDAQ down 56, mid caps down 4, small caps down 5. On a percentage basis, NASDAQ was down 0.5%. That was the big one in terms of a percentage. You can see now the major indices below 20-day moving averages. That means short term, the baton's been handed back to the bears. The bears are in charge. We're back below that 20-day moving average. Until we can get back above it, I think you got to be a little bit more cautious. Normally, when you are rising and you pull back, you hold the 20-day moving average. When you do fail, I do like to watch prior support, and I'm talking short-term support. So here, the S&P, we went below the 20, but we're near that low in mid-November, still slightly above it. The NASDAQ trying to hang on to all these supports, all these price pullbacks that we've seen in the last few weeks down to about 10,900 to 11,000 right in here. Yesterday closing at 10,958. So again, NASDAQ below the 20, but trying to hold on to price support. We'll see if it works. The mid cap index down below the 20, also at its mid-November low. Small caps, pretty much same thing. So we're kind of at a key point here on the chart. I know, 2022 has been horrific. Lots of legs down, lots of bounces, lots of legs down, mostly legs down with a few bounces in between. I do think the market has behaved pretty well since the middle part of the year. It's kind of just been hanging on, a couple bounces, big bounce back in July and August. And then, and you can see that right here, the S&P 500, NASDAQ. But then we went right back down and actually put in a slightly lower low across the board. Mid caps held that low, small caps slightly below. So mid caps really the only one that has held the mid-June low. But this latest recovery has been really weak on a relative basis on the NASDAQ. And so seeing this index roll back over again, I think if we lose the 50-day and then there's that 10,850 gap up, and that was when the October CPI was released on November 10th. That was the day we had that huge gap up. NASDAQ gapped up 4%, just kept going higher. Well, that gap up was right to the 10,850 level. So that's our gap support. We're running out of room to the downside and support. I really think if we lose 10,850 on the close, that increases the probability significantly that we're going to go back down to the low that we saw in October. So just keep that in mind. We're sitting almost where we were at the end of October. Remember, we're in this bullish period where from October 28th close, October 27th close to January 18th close, the S&P 500 over that period has risen 62 of the last 71 years. So we are in a very, very strong time of the year. Now, the S&P 500 is still above where we were back on October 27th. The NASDAQ, however, might be slightly below where we were. I'd have to look and see exactly which close this was, but you can see we're pretty much even with where we were at the end of October. So there's a lot of work still to be done. Can the bulls hold up with these various support levels? We're going to find out. We've got a big inflation report coming up on Tuesday, followed by the Fed meeting, which starts Tuesday morning and ends Wednesday afternoon. We'll get Fed Chief Powell talking to us, giving us the policy statement, 2 p.m. Wednesday afternoon. I think most everyone is expecting a 50 basis point hike. But what does the Fed say? We've been starting to get a little bit more dovish talk from the Fed. Do they put their foot back down again? I don't know. I wish I knew the answer to that because I think that's going to have a big impact on the reaction that we get from that. I mean, I would hope to hear something along the lines of, well, our rate hikes are beginning to slow the economy. We believe that's going to, positively impact inflation. That, from a bullish perspective, is what you want to hear. That will likely continue to send rates lower, and eventually valuations on stocks will go up if rates continue to drop, my opinion. Anyhow, that's the bullish side. The bearish side is you want the Fed to continue on the gas pedal in terms of rate hikes. You want them to basically say, hey, we're going to stay vigilant. We're going to continue to hike rates as we see fit. And, essentially inflation has not really come down much since, we need that series of reports. Those are the two different camps. That's what you're looking at. Anyhow, let's move on here. As far as sectors go, yesterday, healthcare was up 0.8%, staples 0.4%, real estate 0.2%. These were your three winners, and notice defense, defense, defense. The two worst performers yesterday, down 0.6% discretionary, down 0.5% technology, offense, offense. Offensive sectors leading to the downside, defensive sectors leading to the upside. there was really nothing that looked very good yesterday, to be honest. It was not a great day for the market. You know, we sideways consolidated. I guess if there was one positive, we did slow down from the recent sell-off that we had seen earlier this week. 10-year Treasury yield. What the close yesterday, 3.41. You can see right here where we broke down below this high from back in June. So we are now at the lowest level that we have seen since right here before we broke out. So the latter part of summer, right around mid-September, that was the last time we've been in this area, 3.41%. And again, as I mentioned at the opening part of the show, right now we do see the 10-year Treasury yield up 5 basis points, 3.46%. Still way below the 20-day, though, and that's kind of what I'm watching to the upside. All right, economic reports. We do have the initial jobless claims coming out just a little bit later this morning. By the time you're hearing this, it will have been out. The expectation there is for initial jobless claims to jump just a little bit from last week. Last week was 225,000. We're looking for 228,000 this week. All right, moving on to talking technically. Not really a whole lot to add here. I've been talking this week about trying to hold on to that 20-day moving average. A little bit of price support right in here, maybe 39.20 to 39.50 in that range. And then here's that gap support on the S&P. That was 38.60. So those are the three key areas. I know we do have the 50-day moving up as well from underneath. That's at 38.30, so maybe throw that in there as well. But maybe on an intraday basis, going down to 38.30 would be okay. I wouldn't want to close down there. I really don't want to close below that gap support at 38.60, and that's only a couple percent away. So we'll see whether or not the bulls can hang on to what I think is a pretty critical area of support. NASDAQ 100, pretty much same thing, breaking down below the 20. You can see a lot of these closes right around 11.5. And here on the NDX, 11,497 was the close. I believe that is a slightly lower close or open than what we've seen. That is 11,521. That's the open on November 17th. Intraday, we had some moves down near 11.5. Here was the low close recently, 11,503. And then the next day we opened 11,505 and took off. That was the day of the speech that Fed Chief Powell had at 1:30 in the afternoon. That's when the market really took off. Since then, though, you can see we've had selling right back to where we were and even slightly below where we were for that at that time of that speech. Volume's been a little bit lighter if you look down here. So there's mixed signals. We also know seasonally, this is not a great time of the year for the NASDAQ relative to the S&P 500. A lot of the growth areas in the fourth quarter tend to underperform value areas. So if you look at like the IWF, IWD, and you do a comparison seasonality, I'll do this one last thing here. So if you do seasonality and you do IWF, or actually just do IWF, and then down here you can put compare to IWD. And then go, and then drag this over. If we go back 10 years, which is, I like to go back 10 years because that in 2013, that's when the S&P cleared the highs from 2000 and 2007. So to me, that's when the new secular bull market was born. So if we look back just during the secular bull market and we look at the IWF versus the IWD, look at the average relative performance of the IWF, and you'll see that it's negative all 3 months in the fourth quarter. You add those up, and it's minus 1.1 underperformance. That's the average over the last 10 years. So this isn't just something happening in 2022. This is something that happens often. If we go back to the first quarter and do the same, we have average outperformance of 0.9%. Second quarter, outperformance of 1.2%. Third quarter, outperformance of 2.9%. So the outperformance just seems to keep picking up from quarters 1 through 3. And then the fourth quarter, growth tends to struggle. That's been the theme. And part of that reason in the fourth quarter is that financials and industrials tend to do extremely well in the fourth quarter. And that's where a lot of that rotation comes from. All right, let's move on to EB top stocks. If we pull up strong earnings, then we will see MongoDB. This was a company that actually reported earnings on Tuesday after the bell. So yesterday, the stock went up 23%. We can click on that. And one of the things that I had mentioned in the show was it looked like we were going to gap up right near this resistance. And I figured we were going to see a sell-off from the open. That was my guess, educated guess. And we did. We actually opened at 186, or excuse me, 184, got as high as 186. And then we went all the way down to a low of 167. So from the open, we dropped $17, but ended up coming back up and holding the 50-day. So I liked the finish yesterday. We'll see whether or not we can continue to hold that 50-day, but we need to break out above this double top right here. AEHR was another one. This is one that performed really well after breaking down. Now it's trying to get back through the 20-day moving average. I have my doubts, only because we've got a slight negative divergence on the recent high. I think this is one that could go down and test that 20-day. So I'd like the stock a little bit better, down around 2075 to 21, somewhere in that range. The third best performer yesterday in the strong earnings chart list that our members get was Hims and Hers Health, HIMS. Stock's been really on a run to the upside. We've got overhead resistance, 7.25. I would expect we're going to go up and test that. From there, I would expect a pullback, maybe back down to the 6.25 level. That's where we broke out from. There's your 20-day rising up near that 6.25 level as well. So watch that level. Strong future earnings chart list. We had RXDX, big gap up. I'm not sure what the news story was, probably either an acquisition or maybe there was some sort of news. This is a biotech company, so they may have had drug-related news. I don't like chasing stocks like this. When they gap up, I think the tendency is for them to continue drifting lower after that huge volume move. And notice when you gap up on this kind of volume and everybody's buying, we went up over 110. Think about what's happening in the market when there's so much demand and everyone's buying. Who's on the other side of the trade? Many times, most of the time, it's market makers. And that's why you see many stocks refill their gaps, go all the way back down and fill back to the prior open. I'm not saying this one's going to go all the way back down to 36, although it could. But I think that there is a lot of market maker influence here, taking prices lower yesterday after the open. Let's look at the strong AD, which is a strong accumulation distribution chart list. And the big winner there yesterday was ASO. So we'll just jump into that one. Big breakout here. Look at the volume. That was a really nice move. Now you've got a breakout above 52. So 52 becomes your price support. Broken resistance becomes support. That's TA 101. So we closed up near 57. I would not chase it up there, even though it may continue to run. I think in time, you will get the stock back down at $56, or excuse me, $52. And that's where I'd be most interested. On the raised guidance chart list, Guideware, GWRE, was a big winner. I still think we're in this downtrend, though. Nice volume getting back through the 50-day, but we need to clear overhead resistance. Got some work there. Last one I want to show you is AYX. This is Alteryx. This is a software company that's been under pressure for quite a while now. But you can see that PPO just keeps rising. So we have a positive divergence. Nice bullish engulfing candle. I think this one's got a chance to run for the 50-day moving average, which would be up near 48. Again, nice volume, nice reversal there. Let's look to see if we can get through the 20-day. If we do, I think 48 could be in the cards here. All right, let's move on. Put-call ratio. All right, put-call ratio. First thing I want to show you, I'm a big fan. This is one of my favorite sentiment readings, sentiment indicators. Look at this action here in November. I cannot explain it. If we go back and we look at the S&P 500 in November, we are mostly going higher. If you know anything about the put-call ratio, we normally go higher in this ratio when we have extreme panic in the market. Usually at major market bottoms is when we see readings like this. I'm going to put this in perspective. These readings right here at one, anything above one, you can see that there was 1, 2, 3, 4, 5, 6. And we're getting these readings way above one and then coming down way below one and then way back up above one and then way back down below one. I mean, I've never seen this kind of gyration in the equity only put call ratio. I want you to look at the history going back 20 years. This is every day's reading. Here's all of that activity I was just showing you. Look here to see, I mean, we just don't go above one very often. And now all of a sudden, in a good month, we've done it 5 or 6 times. It makes 0 sense. And when something makes no sense to me, I don't pay attention to it. So right now, I'm just disregarding these readings. Hold on one second. So, when I look, and let me just show you the 5-day moving average and give you a sense. This is just over the last year. But normally what happens is we get daily readings that send the 5-day moving average spiking. And here we spiked back in late January. You can see that 5-day moving average. That's a lagging indicator. So you have to see a lot of rise in the daily readings for an extended period of time to start moving this 5-day moving average like this. And the way you get more people buying puts is to see the market going lower. When the market goes down, people get more fearful. And all of a sudden it's like, oh, wait a minute, I need to start buying puts, not calls. And so this ratio of puts versus calls rises. And when we top, it's normally at a market bottom. Top, bottom, top, bottom, top, bottom, top, bottom, top. Yeah, sideways. Top. Yeah, mostly sideways. Top, bottom, top, bottom, top, bottom. Look at it. This was a new high for 2022. Look at the selling that was taking place, the rapid selling. That was panic. That's why you get these readings. They got top here, bottom, top, bottom, top, bottom, top, bottom, top. Do you kind of get the feeling here? When fear rises and more people are buying puts, they can't get enough puts. That's when the market bottoms. Now I want you to look at November. We've been going up almost all month. Here, maybe you can, say bottom, but look at this. We had the highest 5-day reading, one of the highest in our history, right here, right when we were near a 2-month high. Market's not going down. What the heck? I don't know why the put call ratio is doing this. I went into, because yesterday's reading, if we go back to the yesterday's reading, right there, 1.46. This is the highest reading, or maybe it was November 16th. These two are the highest readings ever recorded. This normally would occur when the market is spiraling lower. When we saw reading this high, the previous high reading was right here in 2008 when we hit 1.35. Now we're getting all of these readings up there. This was when we actually had panic going on. Here was 1.1 to 1.15, maybe even close to 1.20. This was in the height of the Lehman Brothers, Bear Stearns. Panic. If you remember the feeling back in the market back then, this was panic. So what the heck is going on? I don't know, but I went over to the CBOE yesterday and looked at the half-hour readings. And now this is the total put call ratio. I'll show you what's going on with the equity only in just a minute. But there's the total. Look at 12 to 12:30. Here we went up. Normally you have the most volume in the morning, and then you start to pick up volume again in the afternoon a little bit. So here we had 687,000 total calls and puts. Then we had another 460,000. I'm just taking the difference between these two totals kind of quickly in my head. 420,000, right around 400,000. Then 318,000. Then 245,000. Then 218,000. And then 900,000 in the middle of the day. We get almost no market action in the middle of the day. Market's usually very boring in the middle of the day. Where in the heck did these 900,000 calls and puts come from? Well, you can see most of them were puts. And if we go down to the equity only put call readings, half-hour readings, look at 12 to 12:30. I mean, most of these readings here, we go up 66,000 in puts and 78,000 in calls. Here we go up 55,000 in puts. Here we go up 74,000 in calls. From 12 to 12:30, we went up 738,000 in puts and 81,000 in calls. The put call ratio soared, equity only soared from 12 to 12:30, which makes no sense. If you're looking at the market, this is intraday. Here's 12 to 12:30 yesterday. Actually, let me clarify, because that is actually 1 to 1:30 Eastern time, because this is Central time. So 1 to 1:30. We go back here, 1 to 1:30. Right here, the market went up. I have no idea what is going on, but I am no longer paying attention to my 5-day moving average because it makes no sense. I'm thinking about going back and filtering this out, and doing a user-defined index and just going into CBOE and doing my own calculation every day, because these readings, I don't know what's going on, but they are skewing our sentiment analysis at StockCharts. And again, I don't know. I've reached out to the CBOE, haven't heard anything. I'm trying to figure out, because this is not the only day. This is what is triggering these high put call readings, are these sudden surges in put volume coming in the middle of the day. But obviously, this has to be institution. This is not retailers who all of a sudden buy this many puts in a 30-minute time frame. Does it have significance? I don't know. I've never seen it before. I don't know what it means. Anyway, earnings spotlight, not really a whole lot going on. Did want to just mention GameStop reported they missed on their earnings yesterday after the closing bell. They had a 31-cent loss versus a 29-cent loss. And if we look at the pre-market action, we're actually up a nickel. So not really a whole lot going on there. Let's take a look at a couple of others that reported, and I'll just show you real quick the three you must see. So we'll look at it on a relative chart very quickly. HCP, HashiCorp, been downtrending. AD line doesn't look bad, but relative strength doesn't look very good within the software space. I would pass. I don't know how they reacted to their earnings, but they did beat their earnings by considerable margin. GEF missed its earnings, 183 versus 197. Stock actually has been doing pretty well relative to the containers and packaging group. I would be watching maybe to the downside, the 50-day moving average, and maybe $65 as your price support. And then this morning, we got a report from Sienna. Again, I don't know how it's done, but it has not been performing well. And it is also, well, that's actually in the telecom equipment space, and it's been a very, very poor performer. If it gaps down with earnings, again, I haven't looked yet, I would be watching this low in October to see whether or not we open below or above that level. All right, that's it for me. I appreciate everybody tuning in. I'll be back on Monday over at Earnings Beats for your next Trading Places Live. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.